Please welcome Chief Financial and Operating Officer, Ashley Johnson.
Good morning, everybody. Thank you for being here. I am really pleased to introduce our next speaker, Katherine Collins. She's the head of sustainable finance for Putnam Investments, and you may have heard her on NPR's Planet Money this past December talking about ESG investments. Katherine is a longtime leader in this space, providing analysis of current and emerging trends in sustainable investing, and is responsible for publishing Putnam's annual sustainability and impact report. She leads the sustainable equity team at Putnam, which collaborates with portfolio managers and analysts in assessing the fundamental relevance of ESG issues at a security level, and then the potential for alpha generation and risk management at a portfolio level. Katherine is the author of The Nature of Investing, Resilient Investment Strategies Through Biomimicry. She's an incredible thought leader, and I'm pleased to say, an investor in Planet. So please join me in welcoming Katherine to the stage today.
Thanks, Ashley.
Thank you for being here. We don't have a ton of time, so I'm just going to dive right into it. You wrote this book, The Nature of Investing, Resilient Investment Strategies Through Biomimicry, basically outlining the concept that investing is both art and science, and that you can be a better investor by watching honeybees. Can you please tell us more about this?
I definitely can, and thanks for starting with that. One thing that is interesting for a lot of us who are working in sustainability is that it sometimes feels like the questions are so big and it's up to us to figure out, how to create a resilient, regenerative system going forward. The great gift of biomimicry is to remind us that we already are living in the greatest possible example of a resilient regenerative system, which is the planet that we get to occupy. And so it starts with this great breath of relief, in fact, that there's actually a lot of resource we already have to turn to. And biomimicry starts with a really simple premise that we don't have to reinvent everything. We can learn a lot from looking at the natural world around us and asking the question, for the function I'm trying to perform here, how would nature perform the same function? How can I look to nature as a mentor and a library and not just a warehouse full of stuff for me to harvest? So it's a really different starting point, both analytically and also kind of philosophically. And if you're an investor, this really can inform you in an important way. Investing, like many other endeavors we have, has been greatly influenced by the industrial era. And so there's a lot of pride placed on kind of rigid systems that are very replicable and scalable, all of which are really important attributes. But using biomimicry as a complement to that can give you a more complete view, a more holistic view. It can help you ask a better question and a more context-specific question. So instead of getting that sort of industrialized one-size-fits-all answer, you get an answer to what is important to investing in this company right here at this moment, something much more tailored and potentially much more insightful.
So I know you particularly like honeybees yourself, but can you tie honeybees back into all of these?
I can, for sure. I mean, if you're ever having one of those wah-wah kind of days, I encourage you just go outside and find an insect to look at for an hour or two. And there's no better insect to observe than honeybees. We all know that they're easy to anthropomorphize. I'll try not to do that. They're even more interesting if you avoid the anthropomorphization and actually look at them as collective societies. One example is honeybees make amazing collective decisions. If they're moving to a new hive location, they'll choose the single best location 80 to 90% of the time. These are odds that any investor would just die for. I mean, I don't know a single stock picker that has an 80 or 90% success record. And so what can we learn from this? When you analyze how those collective decisions are actually made, you see some amazing design attributes. And this is largely thanks to the work of Tom Seeley at Cornell. First, the bees leave the hive. They go out and they explore the actual world around them and gather primary data on what is happening and what is possible in that exact neighborhood that they're in. Then they come back to the hive and they share that information without processing, without spin. When I compare this to what we're doing in the investment world, it's pretty different. You just released earnings. The first analysis that I see is, the change of the delta of the expectation versus the whisper number of the guidance last year. Like, what is that? That's not even a thing. You know, you're 10 times removed from the primary information before you're even done with the first sentence. And so getting back to that primary information and that direct sharing is something really we can pull 100% from how bees make collective decisions, and again, design our own processes, maybe in a slightly different way, hopefully for better outcomes.
That is fascinating, and I'm already hearing a lot of parallels to the conversation that Will and Brad were having this morning.
Very much so.
So coming to sustainable investing, you actually wrote a blog last fall, basically saying that sustainable investing operates in an environment that is both too much and not enough, including constant assertions that the field is both overly ambitious and woefully deficient. And I think my favorite line in that particular article was, ESG metrics do not reflect the awesomeness of the actual world. Tell us a little bit more about what you meant by this.
Sure. Well, here we are in Washington, no better place to note that it's a very polarized time. It almost doesn't matter what the issue is these days. You can find really a wide span of points of view. And so it's no surprise if you say the term ESG in sort of general conversation these days, you get the full gamut of reactions. And this is, to me, not so mysterious. We had a huge growth spurt in this field. The term ESG is used in a lot of different settings to mean a lot of different things. Sometimes it's a compliance function, sometimes it's a value statement, sometimes it has policy implications, sometimes it's an analytical statement. Like, these are not the same conversations, and yet we're using the language as if it's a synonym. So it's no surprise we've landed in this very noisy environment. One thing that really gives me hope, though, is that if I talk to 3 companies in a row or just dive into a big issue, I see this coalition forming around the real substance of our time. So whenever someone kind of baits me in a more politicized question with like, don't you think this, don't you think that? My standard answer now is, it's so much more interesting than that. You know, it's not a yes or no answer, what good carbon management policy might look like. I mean, these are really big, important, foundational questions, and I'm seeing this amazing community, which is really represented so strongly here today, rally up and say, no, we are rolling up our sleeves. We are asking the harder questions. We are doing the harder work. We are not sufficing with sound bites and kind of settling for something that is way up here on the surface. We're really kind of rolling up our sleeves and doing the hard work. I'll give a quick example here just to bring it to light. I was at a meeting last week with a very senior former regulatory official, and about half the meeting was spent really trashing the SEC's current proposals for increased disclosure on emissions for public companies. And there were some good points to that critique, some really valid considerations. But boy, it was dialed up in terms of the rhetoric. And then towards the end of the conversation, someone asked, well, what might a better solution be? And this same official, who had been all riled up a minute before, said, well, what you really would like to hear is from any given company how the movement to a net zero economy is going to affect their business strategy and potential risks and opportunities. And so I went from thinking like, wow, I do not have much in common with this guy, to thinking like, yeah, that is a good question. So when you get to the substance, there actually is a lot more alignment than it might appear from the headlines. And if you're a researcher, this is a dream come true, right? We have big, important questions. We have partial information that is improving day by day. And we have a lot of people, again, kind of rolling up their sleeves, ready to do the work. But what is needed for that? What is needed is primary, relevant, timely, accessible information. And so that's one reason we're so interested in all that's developing here.
Well, thank you. I think you probably, like me, were surprised that the first veto in the Biden administration had to do with ESG.
Yes.
So it's good to see the conversation progressing beyond just the high level, conversation that's so ripe for greenwashing and distraction, but actually getting into the heart of measuring and understanding and using data like Planet's data set to understand how this really does matter. So one of the concepts that we adhere to at Planet is this concept of we have to do well in order to do good. And I think some of our investors who are here are always happy to hear that we are focused on building a sustainable business while also, solving really economically valuable problems for our customers. Because, in a tough economic environment, Doing good tends to take a back seat because everybody has to raise money, generate revenues. So just curious, does this ring true for you, this concept of balancing that doing well and doing good? And just for companies that may be here thinking about going public or are already public and want to understand, how a sustainable investing team thinks about that balance between do well and do good. How do you think about that as an ESG investor?
Yeah, it's a really central question, and I'm intrigued that you use the term balancing. One thing that is terrific from my position, I'm a long-term fundamental active investor, and what that means is I get to choose individual companies that we're investing in and day out. It also means we don't invest in most companies out there. So this is not a perch that every investor gets to occupy, but the great advantage of it is that in doing that choosing, we can identify companies where excellence and sustainability is directly fueling better long-term fundamentals. So it's not an either or, it's not a pie that you're splitting up. It's sort of like this virtuous spiral where doing a better job on the sustainability front is opening up more business opportunity, more profit opportunity, more relevance in the world. So that's a really terrific starting point. It doesn't always happen. There are a lot of businesses where that's not the natural backdrop. There are a lot of situations that are more complicated than that. But when you do find that alignment, whoa, it's super powerful. It means that as the company is growing, the company is getting stronger and the impact is getting better. Like, whoa, that's super cool. So when I think about a company like Planet, and I should have said at the beginning, no investment advice. I'm not talking about stock specific, but when we think about the nature of a company like Planet, there are some really cool attributes that link directly to your question. For any company we invest in, the primary question is, what is this organization doing that's valuable in the world and needed? Might it be more valuable and more needed in the future or not? The second question is, what are the assets that this group has to bear when we're thinking about potential solutions to that initial problem statement? And then the third is, what's the business model and the team that's going to bring it forward? And so we've already talked a lot about the purpose of Planet and the need for this information in the world. And in fact, that's why everyone's assembled here. That middle section of what does this group have to work with is really interesting for Planet. So we've got this hard asset capability with the satellite fleet. I will say we have a whole generation of investors who have learned that asset light is the way to go. And we finally, I think, are getting past that era. It's called assets for a reason. They're supposed to be valuable. And so this idea that there's unique infrastructure that's very hard to replicate, highly technical in nature, is one really important element. And then the second big asset, the data asset, is equally interesting. Here we have a situation where the asset itself is growing temporally. It's growing in terms of both depth and breadth, as you just heard some highlights about. That's really unusual, to see a tangible infrastructure asset that is just as powerful as the data asset that is intertwined with it, and to see both of them evolving in an expansive way over time. Like, ooh, those are neat ingredients to work with. And then you get to the business model, and it's a question of, how are you going to partner? How are you going to make this information valuable and accessible in the world? And who's going to lead all that forward? So all three of those ingredients, the purpose, the assets, and then the business model and team, are really, really fascinating at Planet.
I talked about in the intro that risk management is also an element to this. I know we talk a lot about ESG from the companies that are providing sustainable economic development, but how much are you advising your colleagues on understanding the risk management side of the ESG equation?
Yeah, I'm so glad you asked. One thing, again, that's great about being an active manager is you have the chance to address both the opportunity and the risk. There are a lot of investment settings where it's all risk all day, and rightly so, but that's a really different way to spend your day. When you can see both the risk and the opportunity side by side, it tends to give you a different, and I think an added dimension to your understanding. I will say, when it comes to risk, though, again, this sort of North Star to me of primary timely data is so essential in the world. The biggest frustration of anyone who's trying to assess water risk, for example, or climate risk more broadly, is we're relying on really imperfect models that mostly are fed with information that is months, if not years old, and often very contextually abstracted. This is not a good setup if you're asking a really vital question with respect to the risks at your organization. So, for example, we have a lot of questions about portfolio risk. I can answer a lot of questions on a granular basis, company by company, for the individual organizations we hold and the operations they reflect. But if you just hit sum on that exercise and add it up and say, ta-da, here's my portfolio risk, which is not fair to all the models that are out there, but it's not as far off as I wish it were. That's not a satisfactory answer. So again, that primary timely data that then can be used in a more forward-looking, strategic, decision-useful way is what's really still lacking on the risk side. And so I just love that the risk and the opportunity here are totally intertwined.
It's amazing. I could sit here and ask Katherine questions all day, and I would never get bored. But we have a lot to cover today, and we actually have a customer who's going to come up and talk about how they're putting this into practice. So thank you, Katherine, for your time.
You.
Really appreciate you being here.
Thanks, everyone.